Up first here, Bitcoin tourists have been purged, only hodlers remain. The so-called market tourists are fleeing from Bitcoin, according to blockchain analytics firm Glassnode. This leaves only long-term investors holding and transacting in the top cryptocurrency. According to the July 4th week on-chain report, June saw Bitcoin experience one of its worst months in terms of performance in 11 years, with a loss of 37.9%. Additionally, activity on the Bitcoin network is currently at levels that are comparable to the depths of the bear market in 2018 and 2019. Glassnode noted that despite the almost complete purge of tourists, there were significant accumulation levels. Shrimps, or those holding less than 1 BTC, and whales, those with 1,000 to 5,000 BTC, were increasing their balances meaningfully. According to Glassnode, shrimps are currently accumulating Bitcoin at a rate of almost 60,500 BTC per month, which is the most aggressive rate in history, equivalent to 0.32% of the BTC supply per month. As Glassnode explained, the recent purge of tourist-type investors is likely due to a downtrend in both the number of active addresses and entities on the network since November 2021. This suggests that both new and existing investors are not interacting with the network as much as they used to. The analyst noted that the retention of hodlers is more evident in this metric as active entities is generally trending sideways, which is indicative of a stable base load of users. The number of new entities taking part in Bitcoin transactions is at its lowest since the 2018 bear market. The number of users has dropped to just 7,000 net new entities per day. These figures suggest a lack of new demand, but also that current holders are retaining their Bitcoin despite the market conditions. Glassnode concluded that the more and more people are holding Bitcoin, with the number of addresses with a non-zero balance hitting an all-time high of over 42.3 million. This trend suggests that more and more people believe in the future of Bitcoin. In previous bear markets, investors have sold their Bitcoin when prices have dropped. However, according to Glassnode, the current bear market is different, with investors showing a greater willingness to hold onto their Bitcoin. So that's pretty good. Hopefully that is good news for the Bitcoin infrastructure to come. Up next here, African infrastructure firm lands $150 million to launch crypto water token. According to a recent report, South African investment firm H2O Securities has raised $150 million from Gem Digital through the sale of the H2N token. This is a significant amount of money that will no doubt help H2O Securities continue its work in the digital security space. Gem Digital's investment of a tremendous amount will enable them to hold H2ON tokens, which will guide funding and water delivery infrastructure development to areas lacking sufficient access to fresh water. Gem Digital is an investment firm based in the Bahamas that specializes in alternative investments such as digital assets and resource extraction devices. H2O Securities is working to bring more significant development in water infrastructure worldwide and believes that its solution will increase water availability to the world's population. In a joint announcement on July 4th, CEO of H2O Securities, Julius Stein, said that the H2ON token is focused mainly on financing water projects internationally, rather than on the technical engineering and construction of such projects. Gem Digital is no stranger to investing in technologies designed to improve environmental effects and living conditions for humanity. It has a portfolio that includes investments in firms such as Changing World Technologies, which processes food waste, and Neos Ocular, which produces lasers to improve vision. Gem previously invested in the digital asset management service QBank Holding AB. They are confident in their ability to provide a great service to their clients. The H2ON network will allow for the settlements of bills between participants, which include water plant operators and their clients. H2ON promises to reduce the time it takes for new water suppliers to deliver to their clients in comparison to traditional methods. They plan to finance these water projects by raising funds. H2ON was also listed on Bitmart's centralized exchange Launchpad initial decentralized offer platform on July 4th, coinciding with the announcement. So that's pretty cool. I like when tokens utilize like real world things that are actually going to help society. Up next here, Indian crypto trading volume slump following hefty taxes. The trading volume on 3 major Indian crypto exchanges has decreased by 72.5% on average since July 1st, when a 1% tax was implemented on each transaction in the country. The tax deducted at source policy went into effect on July 1st, resulting in a significant drop in trading volumes on major exchanges. According to CoinGecko, the average volume is down 56.8% since the policy went into effect. This has caused concern among traders and investors. It is clear that the earnings of cryptocurrency exchanges are quite low when compared to other businesses. This is due to the fact that the volume levels are quite low at the moment. For example, WazirX, CoinDCX, and ZebPay only earned a combined total of $21,649 per day. Currently, crypto traders in India, like Mumbai's Shuanak Shetty, are feeling the effects of the TDS and a 30% income tax on cryptocurrency trades. In an interview with Economic Times on July 4th, Shetty stated that he believes that this will be detrimental to the talent base in the South Asian nation. He indicated that, like other traders, he is trying to determine if it is possible to be profitable through trading on Indian exchanges. He went on to say that if the industry conditions do not improve, it is likely that there will be another brain drain of professional traders to other countries that are more welcoming. Anuj Chaudhary, policy analyst for WazirX, explained in the June 30th episode of the WazirX show on YouTube that the 1% TDS is levied on all digital assets, including NFTs, crypto assets, and metaverse assets, regardless of the platform or public blockchain they are traded on. The tax will be in effect for a period of 3 months in order to assess its impact on the market. Although trading volumes are low at present, policymakers wish to see its results over a longer time frame. The tax does not apply to gift cards that are used to obtain goods or get a discount, mileage points, reward points, or loyalty incentives without monetary considerations, or to subscriptions to websites, platforms, or applications. Chaudhary's counterpart on the show, Muthuswamy Iyer, head of legal at WazirX, accurately predicted that the TDS would hurt high-volume, high-value traders on Indian platforms. He added that he believes the TDS would also dissuade newcomers and low-frequency traders from gaining crypto exposure. The daily transaction volume between WazirX, ZebPay, BitBNS, and CoinDCX has fallen from an average of $9.6 million per day in June to $5.6 million as of July 4th. So that's unfortunate. We will see the long-term effects of that, I'm sure, within the coming months. Up next here, ECB officials prepare for harmonization of crypto regulations. The European Central Bank will be issuing a warning to European Union member states about the need for harmonized regulations for cryptocurrencies. According to the Financial Times, the European Central Bank, or ECB, is concerned about the possible regulatory overlap between central banks in the European Union and crypto companies as officials prepare to implement the markets and crypto assets framework. The European Parliament, European Commission, and European Council reached an agreement on June 30th to bring crypto issuers and service providers within their jurisdictional control under a single regulatory framework. According to reports, regulators from 19 EU member states will attend a supervisory board meeting in July to discuss the possible implementation of MiCA. If implemented, the law would require asset service providers to adhere to certain requirements aimed at protecting investors, as well as warn clients about the potential risk of investing in a volatile crypto market. EU officials would then have an 18-month review period to assess the proposed regulatory framework and determine whether it includes other crypto-related products, such as non-fungible tokens. The MiCA regulation presents a considerable challenge for national regulators who must decide whether to allow businesses to operate without regulation until MiCA is enacted, or to assert greater control over the situation. Before the European Union's Market in Crypto Assets, or MiCA framework came into effect, individual member states were largely responsible for regulating cryptocurrencies within their own borders. However, officials recently reached an agreement on forming an authority to supervise anti-money laundering regulations for crypto firms. In Germany, the Federal Financial Supervisory Authority, or BaFin, is responsible for issuing licenses to crypto firms interested in offering services within the country. So it looks like they're just trying to get a more wide range regulation on that. You know, I'm sure people in Europe have pros and cons on how that's going to affect them. We will see more to that to come. Up next, some news on Celsius. Celsius pays down $143 million in DAI loans since July 1st. Since the beginning of the month, Celsius has repaid a substantial amount of its outstanding debt to the Maker protocol, signaling that the troubled crypto lending platform is trying to stave off a complete collapse. These repayments come amid credible rumors of insolvency, which suggests that Celsius may not be able to sustain itself much longer. While it remains to be seen whether or not Celsius will be able to keep itself afloat, the recent repayments to Maker suggest that the platform is at least trying to avoid a total collapse. Since July 1st, Celsius has repaid $142.8 million worth of DAI stablecoins across 4 separate transactions, according to data from DeFi Explorer. The crypto lender still has $82 million in outstanding debt owed to Maker. Out of $1.8 billion in lifetime investments, the firm's losses currently stand at $667.2 million. The liquidation price of Celsius's wrapped Bitcoin loan has reportedly dropped to $4,966.99 Bitcoin following the repayment of the loan. This is a significant decrease from the previous liquidation price of nearly 64 million DAI. The decrease is likely due to the recent payment of $50 million in DAI. Celsius is one of a number of crypto companies that are insolvent following the recent market conditions. The firm has stopped withdrawals and is seeking new legal advice in order to restructure. Goldman Sachs is reportedly looking to acquire the company's assets. As of last week, despite liquidity issues and signs of an imminent collapse in its business, Celsius was reportedly still paying rewards. However, due to liquidity constraints, Celsius users were unable to withdraw their rewards. So, seems strange that they're doing that, but who knows? I'm sure there's a reason. Last up here, Singapore's financial watchdog considers further restrictions on crypto. The Monetary Authority of Singapore is actively considering new measures that would restrict retail investors' ability to trade cryptocurrencies. This is according to a senior government minister who stated that the MAS is taking a careful approach to the issue. In a parliamentary meeting on Monday, Singapore Senior Minister and MAS Chair Tharman Shanmugaratnam, sorry if I pronounced that wrong, stated that the financial watchdog may consider restricting retail participation for crypto investors, as well as introducing rules on the use of leverage for crypto transactions. Shanmugaratnam also called for greater regulatory clarity among financial regulators around the world, noting the borderless nature of cryptocurrency markets. In January, the Monetary Authority of Singapore took measures to restrict crypto service providers from advertising or marketing in public spaces. This was in response to concerns that such activities could trivialize the risks associated with cryptocurrency trading. Under the Payment Services Act, the MAS has the authority to impose additional restrictions on crypto service providers in order to protect consumers and safeguard financial stability. The MAS has reprimanded Three Arrows Capital for allegedly providing false information and exceeding the assets under management threshold. Recent events have highlighted the risk of crypto assets, and the Singapore-based company may face a liquidation if it fails to meet margin calls from its lenders. The MAS is currently undertaking a review of digital asset companies in Singapore in order to decide whether or not to grant them regulatory approval. In June, the financial regulator granted Crypto.com an in-principle approval, allowing the crypto exchange to provide certain payment services in the country. Crypto companies including Bitstamp Limited, Coinbase Singapore, and Gemini Trust have been granted exemptions for having a license in Singapore, while Binance announced plans to shutter its operations in the country in February. So a lot going on with regulation, a lot of new updates today. Thank you guys so much for watching. Make sure to like, subscribe, hit that notification bell, leave a comment on what you want to see in a future video, and we'll see you next time.